Hey, Carl, great to see you. Well, I think it really is about commodities and a lot of the disinflationary conditions that were emanating from a sell-off in multiple commodities, specifically natural gas and crude oil. We saw that reverse early this morning. A lot of that on the reopening, the soft reopening for China. And the minute that we saw that move higher in energy, that's when the market kind of began to fall through and go back to what it's done the last several weeks, which was any bounce was met with aggressive selling pressure.
So despite all the chatter going into the week that we were in a calendar period where rebalancing was going to help, good seasonality, you're still favoring healthcare and to a lesser extent energy?
Yeah, I think, look, Carl, you have to be diversified in this market. You can't have any form of concentration. And the reasoning is clear. The cost of capital in 2021 was free. The cost of capital in 2022 is a moving target. What is the terminal rate for the Federal Reserve? Well, last week, as we saw commodity pricing begin to come down, as we saw energy pricing come down, there was a belief that, well, maybe the Federal Reserve will reach a moment here at 2022 where they'll begin to end the process of raising rates. You take that off the table today if we're going to continue to see energy prices move high, inflationary pressures emanate through the economy. It's a moving target. And if it's going to be ultimately a moving target, then that means that the valuation recession that we're in right now is going to specifically target long duration assets. That's where the challenge is ultimately going to be. It was reflected in the tape today. And your defense mechanism against that, because you're going to have persistent and elevated volatility, is to ensure that you're diversified, look towards sectors like healthcare that offer the proper blend between offense, defense, growth, and value. And that's going to be the way that you're going to be able to kind of mark through this process of time in a way that's more defensive in its nature.
Joe, let's bring in our CNBC contributor on the newsline, Bryn Talkington of Requisite Capital. Bryn,
sure.
To Joe's point, your larger idea regarding the markets has been the market can't take its eye off the ball, and the ball is, in fact, the Fed.
Yeah, I mean, absolutely. It's like you have to go back to the old tried and true, adage, don't fight the Fed. I think that investors need to understand that we're seeming to have a longer-term macro regime change. And so if you think back the last 10 years, you had global central banks increasing their balance sheets and keeping rates at zero. Now we have global central banks reducing their balance sheets while increasing rates. And so I think that if you also look at the last 10 years, 40% of the return from the S&P came from actually multiple expansion, and only 15% came from dividends. Historically, that's almost the reverse, where about 50% came from dividends. And so I think investors need to do two things. Lower their expectation for returns going forward and think through that we are having this regime change. And I agree with Joe about healthcare, looking for dividends, because I do think that longer duration assets are going to just be at risk from how much the market wants to pay for them while we are going through this, really repricing of assets, because ultimately it doesn't matter what earnings a company has. It matters what multiple the market wants to pay for those earnings.